guys, Mariko Realtor with Bridgewell Real Estate Group. And on today's video, I've actually brought on Ryan Oak, who you guys will have seen before if you have watched the other videos. And we're going to be talking about everything that you need to know with regards to these interest rate increases. The Bank of Canada is obviously a very hot topic right now. So we're going to try and do everything that we can to simplify this and make it as easy as possible to digest. But obviously with numbers, that's not always the easiest thing. But Ryan's a pro, so I'm going to let him introduce himself and then we're going to get into it.
Hi, everyone. My name is Ryan Oak. I have my own company set up with my father, Kevin, Oak Mortgage, and we're partnered up with Dominion Lending Center's Producers West Financial out in Langley, BC.
Awesome. Thanks for being here, Ryan. And I think just to start, I mean, I know we've already done another video on this, but if you could just very generically go through the difference between like what is a variable rate and what is a fixed rate, I think that'd be an awesome way to start this off.
Yeah, so a fixed rate, you are locked into one specific interest rate for the entirety of your term. So if you have a 1 year, 3 year, 5 year fixed rate term, you have that same interest rate every month for the entire term. A variable rate mortgage is prime plus or minus discount or premium. So if you had prime -1, you're going to keep that discount the entire term, but the prime rate might change throughout that term, which would increase or decrease your payment depending on where prime rate goes. There are also some lenders that offer static payments for variables, but we can get into that a little bit more.
Cool. Yeah, and for anybody that like hasn't seen the channel before, hasn't seen Ryan on, we do have a really great video that is essentially like breaking down a fixed rate versus a variable rate and interest rates like in a lot more detail than this. So I'll leave a link and you guys can watch that as well if you're interested. But yeah, so you're briefly touching on like prime and all these things. And so can you kind of just go over like when you see increases for variable rates versus when you see increases for fixed rates?
Yeah, so variable rates are generally going to be changed when the prime rate increases or decreases. And that is dictated by the Bank of Canada, who sets the target overnight rate. So the target overnight rate is the interest rate that they allow other banks to lend money to one another at. And if they increase that interest rate, which means charge the banks more money, they're going to pass that cost onto the consumer by increasing the prime rate. So all these interest rate hikes that you've seen to variables, unsecured lines of credit, anything that has a variable interest rate, anytime you've seen a change this year, that's been the result of the Bank of Canada increasing their target overnight rate. The fixed rates, however, are dictated more by bond yields, and bond yields are a reflection on how the economy is doing, whether it's unemployment, GDP, how our currency is doing compared to other countries' dollars. That's going to dictate where the bond yields go. And the banks are in charge of changing their own fixed interest rates, and they usually follow in step with where the bond yields go.
Okay. And then so generally, I guess the variable payment or variable interest rate is more so linked to the Bank of Canada, correct?
Correct.
And then the fixed rates are more so linked to bonds and bond yields, right?
Correct.
So then like, what is that relationship with variable and fixed rates? Like, is a variable rate usually lower than a fixed rate? Is it the opposite? Like, what does that look like for people?
As long as I've been in the industry, which is 8 years now, I've always seen the variables at a lesser interest rate than the fixed rates whenever somebody's going to apply for a mortgage. Obviously, the benefit of the variable of it being lower, you have the risk of it potentially going up in the middle of your term versus the fixed payment remaining where it is for the entire term. They generally follow in the same direction, but they're not going to do it at the same time. So if you remember at the beginning of this year, you had net variable rates below 2%, while fixed rates had started climbing already close to 4%. So you saw them get almost a 1.5% jump on the variable rate. And now you're seeing the variable rates coming up behind, where they've been increasing every couple of months, where the fixed rates have kind of fallen off for the last 2 or 3. So they generally follow in the same direction because they're all a reflection on how Canada is doing as an economy, but they might not be changing at the exact same time.
Right. So just because the Bank of Canada has made all these announcements and like increased the variable rate over the course of the last year or so, doesn't necessarily mean that the fixed rate is increasing at exactly the same rate.
Correct. Those announcements that the Bank of Canada does, that everybody puts on their headlines, that you click on Facebook and social media for the clickbait, those are only variable interest. Those Bank of Canada meetings, the result is only going to impact the variable rates at that time. It might be a coincidence that bond rate or bond yields go up or down during that time, but those meetings, the result is a change to the target overnight rate or no change. And that will dictate the prime lending rate that you have with your bank.
Okay. And then so like, I mean, they're not necessarily directly related to each other, or like they're going to move in exactly the same fashion, but because they're all a reflection of the economy, I guess, like, is it normal to see kind of like, oh, the Bank of Canada increased their interest rates, and then so the fixed rates will likely follow? Is that a normal relationship?
It very well could be. I mean, everybody's been criticizing the Bank of Canada for being late to the game to address inflation.
Mm-hmm.
And I think you saw unemployment and us coming out of COVID really forced the fixed rates up early.
Mm-hmm.
But because it took a while for the Bank of Canada to start increasing the target overnight rate to combat inflation, I think that's why you saw fixed rates go up so quickly before the variables did.
Mm-hmm.
And why the fixed rates, because they moved first, you're seeing them kind of plateau while the variables are still climbing.
Interesting. And I don't know if you know this, but like you were saying back earlier in the year, there was like a 1.5% spread. Like, is that normal to see such a large spread between variable and fixed, or is it usually a lot closer, or does it just kind of depend?
I've only really seen this once before. I believe it was if I have my dates right, I think it was the end of 2018, beginning of 2019, where the fixed rates went up quite a bit, but they didn't go up by such a large amount over such a long period of time like they have been right now.
Yeah.
I can't remember. I don't recall the variables taking that long to move back up with the fixed rates. It's definitely a unique situation right now, but based on the other brokers that I've heard who have been in the industry for 12, 14, 15 years, it's kind of a cyclical repetition here where this has happened multiple times before.
Yeah.
And it usually results in a plateau of rates with you might see a small decrease coming in the near future.
Interesting. So I guess the other thing that I kind of want to understand is like what it actually means to people. So like, okay, the Bank of Canada increases their interest rates and it affects the variable rate, like mostly for what we're seeing right now. So like the most recent interest rate increase that they did was a full percentage, which was a huge deal in the industry. And so what does that actually mean to a variable like interest rate person that's locked in that situation, and like that 1%, what does that mean for their actual mortgage payments increasing?
So I've got a little cheat sheet just so that I don't screw these numbers up. I did two different calculations. So one is if generally it's easy to communicate these numbers to somebody if you just say per 100,000. So if someone had a $100,000 mortgage outstanding at prime, which is right now 4.7, they would be paying $564.65 a month.
Yeah.
If that same mortgage increased by 1 full percentage point, so the prime rate went up 1% to 5.7, that monthly payment is going to go up to $622.08. That's a $57.43 increase, just over 10%. So if you extrapolate that out for a $500,000 mortgage at prime, you're $2,823.23. You're going to have the same 10.17% increase to the payment. So that's $287.19 added on to your monthly payment for a 1% increase. And now you're paying $3,110.42.
Mm-hmm. I think that's really helpful because I think that like, obviously that is a large amount of money, but I think like putting it into that dollar perspective is really important. I had somebody say to me like, oh, you know, this interest rate increase, like it means that my payment's going to double. And it's like, well, no, it doesn't actually mean your payment's going to double. Like it is going to go up and it's going to be substantial. But I think there's just a lot of like fear and panic and like, you see these interest rates doubling in some situations, and people just think, oh, that means my payment's going to double.
Well, and to bring it back to that variable that we were talking about at the beginning of this video, the static payment, this is why I always recommend to people, if you can keep up with that variable payment, do it. Because what happens in those static variable payments is, if your payment's $1,000 a month, 500 is to principal, 500 is to principal, 500 is to interest, like we were saying before. If that interest rate goes up, you can still pay $1,000, but now you're paying 700 in interest, 300 in principal.
Right.
Now for the last 5 years, you might still have, so if you started at 25 years amortization, paid your mortgage off for 5 years, you could still potentially owe 23 years on your mortgage because you haven't been paying enough principal.
Mm-hmm.
So if people want to keep their payments the same, if you're in those variable rate mortgages, if you can maintain the increases, you should definitely do it. Mm-hmm. Yes, it's going to hurt the wallet, especially the rapid increases that we've seen over the last 4 or 5 months. Mm-hmm. But it's well worth it in the long run, because you don't want to be adding on to that amortization and making your payments count towards very, very little in repayment.
No, I think that that's a really good point. It's like, obviously it does affect people and it hurts the wallet, but at the same time, it's like, if you are just keeping that static payment, more of your payment is just going towards interest. And you're right, you're affecting your amortization, how long it takes you to pay it back as well. So that's a really good point. So the other thing I want to get into that I think is like a conversation that people have is like, oh man, like, you know, earlier in the year, the fixed rates were at this rate and I decided to lock into a variable rate. And now it's like the variable rates have gone up so much. I should have just locked into that lower fixed rate. So what do you say to those people? How do you feel about that? And like, is like, in terms of the payment, would it actually have been better? Can you kind of unpack that?
So we've been sending out emails to all of our variable rate clients after every Bank of Canada change to the interest rates that have happened this year. Mm-hmm. I think we've had, well, I don't even want to guess right now. I think we've had 6 meetings so far this year. I think we've seen 4 increases. I could be wrong on that, but regardless, we've been sending out updates to everybody on what our outlook is moving forward.
Yeah. And
I think to this day, we are still recommending that people that are in variables do not lock in to the fixed rates. Mm-hmm. People might think that's crazy. That's my opinion. It's not, there's no right or wrong. It's basically whether or not you're okay with the risk and you're okay with remaining in those fluctuating payments. But the biggest thing for me is the ability to get out of that mortgage at a minimal cost versus if you were in a fixed interest rate and the exponentially higher penalty you would be paying to break that mortgage. So perfect example, we recently just moved to Langley. We had a fixed rate mortgage. We thought we were going to be in our 1-bedroom condo for 4 or 5 years. We were there for 3. And we wanted to move to Langley. And I wanted to start brand new with a new lender, pay out our previous one, and start all over. Our penalty to break a $260,000 mortgage was going to be close to $10,000 just to walk away. If we were in a variable interest rate, the penalty would have been, I think we would have been $2,200 to break that mortgage.
That's crazy.
And our interest rate was fixed. So we would have been able to get a better fixed rate, or we would have been able to get an exponentially lower variable rate. I think the net variable rate would have been 1.7. But to avoid paying that penalty, we brought the mortgage with us over to the new one. And we basically are still in that same fixed rate. It's blended with a new term and everything like that. But the fixed rate is okay. And we could have been in a better position if we had taken the variable back then. And I wish we would have. Mm-hmm. So the ability to maneuver, and if you're selling your home, if you're upgrading, downgrading, like, you never know what happens. Job changes, relationship changes. If you need to get out of that mortgage and you want flexibility, you want to be in a variable rate. Mm-hmm. If the prime rate also keeps going up and people keep looking at the fixed rate, oh, I could have had this, I could have had that. Keep in mind, most of you are in a 5-year term. The stress test for mortgages has barely been around. I don't even know if it's been around fully for 5 years. It has been for insured mortgages, but I don't think for conventional. Mm-hmm. A lot can change in 5 years. And if the prime rate starts leveling off and inflation starts coming back down, you might start seeing a dip in the prime lending rate, whether that's in 4 months, 6 months, or 24 months. It's a guessing game, but it's a definite possibility that you're going to see the prime rate drop back down. And for me personally, I would have preferred to have been in a variable interest rate, fully aware that I could have had several months of payments at a fixed rate that would have been less, but I would have wanted the ability to have that rate come back down if it did.
Mm-hmm. Well, I think that like it's really interesting because I don't think you're alone in that statement, like with regards to still being pro variable. I find like a lot of the mortgage brokers that I talk to, or just people that I listen to, all these different things, like a lot of them are pro variable. And so I think it's good to kind of have these conversations and give the public a different perspective. Because
And one of the things I like to tell our clients is we're not paid more money by the bank if you go into a variable or if you go into a fixed. It's the same. We're getting paid the exact same referral commission to put you into a 5-year fixed or a 5-year variable. It's completely up to the borrower whether they're okay with that fluctuation, that risk. I know some people that they'd be waking up every morning curious where their rate is and whether it's going to change. And that's a bad habit to have for 5 years every day.
Yeah.
So those kinds of people, they need the fixed rate because they need the certainty.
Yeah.
Other people, they can allow that kind of risk into their lives and they're okay with it. And if they are, I would definitely recommend going that way. Whether that's going to be the same statement in a couple of months, I don't know, but right now it is.
Mm-hmm. I don't know if, like, I haven't fact checked this in a while, and I don't know if you have any opinion on it, but I heard something a couple years back that like 60% of the 5-year like fixed mortgages get broken, which is crazy. It's like everybody
at the exact same point we broke ours. Well, technically we didn't break it because we ported it over, but we were considering breaking it at that same point.
Yeah. And that's so interesting. It's like everybody thinks, like you said, oh, we're going to be here for 4 or 5 years, like no problem. Or yeah, but life happens and things change, and 5 years is a long time. So no, I think that those are all excellent points. So I think that's really like everything that I wanted to go through today. And I guess like my final question was that I hear a lot of brokers recommending variable, and I think you kind of answered that, but yeah, I really appreciate you being on and talking about everything. As you can tell, like Ryan's obviously our like go-to for mortgage brokers. He's definitely an expert in the field and is very honest and can tell you his personal opinions, as he did today, on fixed versus variable and just kind of molding it to each person's situation and what's best for you. So I definitely recommend that you guys reach out to him if you have any further mortgage questions. And we really hope that you enjoyed watching this video. If you have any more questions that come up, or comments, or anything regarding these Bank of Canada interest rate hikes, or where you think things are going to go, we'd really appreciate you guys commenting, and stay tuned for more videos. Thanks again, Ryan.
Thanks for having me, Mariko.